$1,000 invested in Amazon in 1997 will be worth over $1.5 million today. That's not luck. That's understanding how the stock market works. And the good news, it's not nearly as complicated as people make it out to be. So stick around because in the next few minutes, you're going to learn everything you need to know to get started. And if you want to learn more about investing and some of the stock picks we're eyeing right now, go ahead and subscribe to this channel and hit that notification bell to make sure you don't miss another video. Now, here's a stat that should bother you. Nearly half of all Americans own zero stocks. Zero. And it's not because they can't afford it, not because the market is closed to them or not available. It's because the stock market feels like a foreign language. It's confusing, risky, reserved for people in suits on Wall Street. And I get it, the terminology alone is enough to make your eyes glaze over. Bid-ask spreads or PE ratios or market capitalization. It sounds like you need a finance degree just to get started. But here's the thing. While millions of people sit on the sidelines, inflation quietly erodes their savings every single year. Think about it this way. The average savings account is paying somewhere around 2 to 3% annually. Inflation, historically around 3%. That means your money is barely treading water if you're not investing. Meanwhile, the S&P 500, just a broad index of 500 major U.S. companies, has returned an average of roughly 10% per year over the last century. That gap between sitting in cash and being in the market over 20 to 30 years, it's the difference between financial stress and financial freedom. Now, the stock market is not a casino. It's a system, and systems can be understood. So let's break it all down. So let's start from the very beginning. What actually is a stock? A stock, sometimes called a share, is a fractional ownership stake in a company. That's it. When you buy a share of Amazon, you're not just buying a piece of paper, you literally own a tiny slice of that business. Think about it this way. Amazon is roughly 1 billion shares outstanding. If you buy one share, you own 1/1 billionth of Amazon. Now, that sounds small because it is, but it means you're entitled to 1/1 billionth of its profits, 1/1 billionth of its assets, and in some cases, 1/1 billionth of the voting power on major company decisions. Now, there are two main types of stock worth knowing about. Common stock is what most people buy. You get voting rights, which means you can vote on the things like who sits on the company's board of directors, and you benefit when the stock price goes up. Now, preferred stock is a bit different. Preferred shareholders usually don't get any voting rights, but they do get a priority when the company pays out dividends. And speaking of dividends, let's actually define that. A dividend is a cash payment a company makes to its shareholders, usually every quarter. Now, not every company pays dividends. Younger or high-growth companies like Amazon typically reinvest all their profits right back into the business. But mature, stable companies, think Johnson & Johnson, Coca-Cola, Procter & Gamble, they tend to pay consistent dividends as a way of rewarding long-term investors. So if you own 100 shares of stock that pay a $2 annual dividend, that's $200 a year just for holding that stock. It's not glamorous, but it adds up and it compounds over time. And if you want to dive in deeper, we recently identified 3 stocks that we think could double or more in 2026. Now, if you're interested in which ones those are, I'll put a link below in the description, or you can simply scan the QR code here to access the free report. Okay, so now you know what a stock is, but why does a company sell stock in the first place? The answer is simple. They need money to grow. So let's say you built a software company. You start in your garage, you've got a great product, and now you want to hire 50 engineers and open offices in 3 cities and expand into new markets. That costs tens of millions of dollars, and you could take it out in loans, but debt has interest payments, and if things go south, lenders want to be paid first. Or you could bring in investors by selling a piece of your company. For most of a company's life, this actually happens privately. So venture capitalists, angel investors, and private equity firms buy ownership stakes in companies. That's what private company means. It means the shares aren't available to the general public. But at some point, many companies decide to open the doors to everyone. That's called an IPO. You might have heard of this. Initial public offering. It's the moment a company goes public, listing its shares on a stock exchange for the first time so that regular investors like you and me can buy in. Now, you've probably seen big IPOs in the news. When a company like Airbnb or Rivian goes public, there's usually a lot of fanfare. That's because IPOs are often priced based not just on what a company is worth today, but what Wall Street believes it will be worth in the future. And this is actually really important to understand. Stock valuations, what they're worth, are often forward-looking. A company with almost no current profits can still command a massive valuation if investors believe the future earning potential is enormous. So that's why early investors in companies like Amazon or Netflix made fortunes. They were betting on where those companies were going, not just where they were at the time. So stocks can be great investments, but where does all the buying and selling actually happen? It happens on a stock exchange. Now, think of a stock exchange as a marketplace, like a farmer's market, but for shares of companies instead of tomatoes. It's the place where buyers and sellers come together to trade. Now, for most of history, this was actually a physical place. You might picture the floor of the New York Stock Exchange, traders in jackets shouting and waving papers in the air. Specialists would manually match buyers with sellers. It was chaotic and it works. But today, it's all electronic. The modern stock exchange is essentially a sophisticated computer system that processes millions of transactions every single second, matching buyers and sellers instantly at whatever the current market price is. The two most well-known exchanges in the US are the NYSE, the New York Stock Exchange, and the NASDAQ. Now, the NYSE tends to list older, more established companies. Think Walmart, JP Morgan Chase, Coca-Cola, things like that. NASDAQ leans more heavily tech. Think Apple, Microsoft, Google, Meta. Now, when a company lists on an exchange, it agrees to meet certain reporting and compliance standards, publishing quarterly earning reports, disclosing major business developments, and so on. That transparency is actually part of what makes public investing possible. You can look up exactly how much money Apple made last quarter, how much debt they carry, and what analysts think about the stock, which actually brings up a good question. With thousands of stocks listed across these exchanges, how do you know which ones are worth your attention? Well, this is where tools like WallStreetZen become really useful. Rather than digging through SEC filings and financial statements yourself, WallStreetZen aggregates everything: analyst ratings, financial health scores, earnings reports, and more into a clean interface designed for investors who actually want to do their homework. Now, the link to WallStreetZen is in the description, but we'll come back to that in a minute. Okay, so now that you know where stock trading happens, here's a part that actually trips a lot of people up. If you buy a share of a company, why does its price go up or down? The short answer to that is really supply and demand. Now, here's an analogy that might make supply and demand easier to understand. Let's say you list something for sale on Facebook Marketplace, like an old guitar for $200. Within an hour, you've got 40 people messaging you asking to buy it. What does that tell you? You probably priced it too low. So maybe you raise the price to $350. Now you get 5 responses instead of 40, but you get closer to the real market price. The stock market works the same way. If more people want to buy a stock than to sell it, the price gets pushed up. Now, if more people want to sell than buy, the price falls. It really is that simple at its core. But let's add a layer here. There's something called the bid-ask spread. Now, at any given moment, there is a price buyers are willing to pay, that's the bid, and the price the sellers are willing to accept, that's the ask. The difference between the two numbers is the spread. So when you hit the buy button on your brokerage app, you're actually buying at the ask price. And when you hit the sell button, you're actually selling at the bid price. But here's what really drives price over time: fundamentals versus sentiment. In the short run, prices can move on pure emotion, a tweet, a news headline, or a rumor. Sentiment is powerful and sometimes irrational. That's why you'll see a company's stock drop 10% in a day, even when nothing has fundamentally changed about the business. But in the long run, a stock eventually reflects the actual performance of the company behind it. So things like revenue growth, profit margins, debt levels, and competitive positioning, these are things that compound into real returns over years and decades. All right, so now you know what a stock is, why companies sell stocks in the first place, where stocks are bought and sold on exchanges, and why the price of a stock goes up and down. But this next section is critical, and it's the part that most beginner investing videos skip. They teach you what a stock is and say, hey, go open a brokerage account. That's really not enough. Before you choose to buy any stock, there are 4 things that you need to understand about it. Number 1 is, what does this company actually do and how does it make money? Now, this sounds obvious, but you'd be surprised at how many people buy stocks and they can't explain this. If you can't describe a company's business model in 2 sentences, you are not ready to invest in it. Second, you need to understand if the business is actually financially healthy. So go look at revenue trends. Is the company growing? Look at the earnings. Is it profitable or is it burning cash? And look at the debt. How leveraged is the balance sheet of this company? A company drowning in debt with shrinking revenue is a very different investment than a company with no debt and 20% year-over-year growth. Now, third, you need to ask, what are the experts saying? Analyst ratings aren't perfect, but they do reflect thousands of hours of professional research. And if a stock has 20 analyst ratings and 18 of them say buy, that's meaningful data. And if 15 of them say sell, you should at least understand why before you would go against the grain and buy that stock. And fourth, you need to ask, is the valuation reasonable? Now, even a great company can be a bad investment if you overpay for a stock. So look at the company's price to earnings ratio, the PE ratio, and use it. Compare a company's valuation to its historical average and to competitors in the same industry. Now, gathering all of this manually can take hours, which is exactly why WallStreetZen was built to solve. The platform pulls together the financials, the analyst consensus, the valuation metrics, and a proprietary stock score so you can evaluate a company quickly without needing a Bloomberg terminal or a finance degree. Now, it doesn't make the financial decision for you, but it does put the research in front of you in a format that actually makes sense. And finally, one more thing before we move on. Only invest money you can afford to leave alone. The market moves in cycles. Even great stocks can have rough stretches. And the people who lose money are almost always the ones who were forced to sell at a bad time because they needed cash. Invest with a time horizon of at least 3 to 5 years, and only with money you won't need any sooner than that. All right, let's talk about the practical side of things. How do you actually buy a stock? Well, first you need a brokerage account. Think of it like a bank account, but designed for investing. You deposit some money into it, and from there, you can buy and sell stocks, ETFs, and other securities. Now, your main choice is between a traditional brokerage, something like Fidelity, Schwab, or TD Ameritrade, and a commission-free platform like Robinhood or Webull. Now, traditional brokerages tend to offer more robust research tools, better customer support, and broader account options like IRAs. Commission-free platforms are streamlined and beginner-friendly, though sometimes at the cost of features and depth. Neither one is wrong, but your choice should depend on how seriously you plan to engage with your investments. Now, once you have an account open, here's a principle worth baking in from day one. Don't just buy one stock. Diversification is not just a finance buzzword, it's the most practical risk management tool available to you. If you put everything into one company and it craters, you have no cushion. But if you own 20 companies across different industries, a bad quarter from one doesn't define your entire portfolio. And if you're worried you can't afford shares of expensive companies, Amazon, for instance, trades at over $150 a share, many brokerages now offer fractional shares. So you could just invest in dollar amounts and not have to buy a whole share of stock. So you can invest $25 in Amazon and just own a fraction of a share of it and still participate in its growth. This has made diversification genuinely accessible to investors starting with even a small amount of money. So start small, get comfortable, and learn as you go. The goal right now isn't to make $1 million, it's to understand the system well enough that you can make informed decisions. All right, we've covered a lot of ground today. Stocks, exchanges, IPOs, dividends, price movement, how to evaluate and purchase stocks. But the market is deep and there's more to explore when you're ready. We didn't really get into ETFs and index funds, which are honestly where most beginners should probably start. We didn't cover options or margin trading. Those are more advanced tools that can amplify both gains and losses. And we only scratched the surface on fundamental analysis. There are dozens of additional metrics worth learning over time. Now, none of that should overwhelm you. Just think of investing as a skill. You don't need to know everything on day one. You just need to know enough to start and then to keep learning. Now, if you want to go deeper, WallStreetZen isn't just a research tool, it's also a resource for education. We publish in-depth articles, stock analyses, and guides built specifically for investors who are learning the fundamentals. It's worth bookmarking if you want to learn more. Again, the link is in the description below and in the pinned comments as well. So let's bring it all back to where we started. $1,000 invested in Amazon in 1997 is worth over $1.5 million today. Now, the people who made that return weren't geniuses. They weren't insiders. They just understood what a stock was and they believed in what Amazon was building, and then they simply didn't panic when the stock dropped 90% during the dot-com crash. They held on. You now have the foundation to make decisions like that, informed, intentional investing decisions grounded in how the market actually works. The only thing left to do is to start. Now, if this video helped you at all, hit the like button below. It genuinely helps this channel reach more people who need this type of information and education. And if you want to keep building on what you learned today, watch this next video right here.